Welcome to Stocks in Translation, Yahoo Finance's video podcast that cuts through the market mayhem, the noisy numbers, and the hyperbole to give you the information you need to make the right trade for your portfolio. I'm Jared Blikre, your host, and back with me is the voice of the people, Sydnee Freed, who is here to ask the people's questions and keep us honest. It has been a while, Sid.
It's been a while. I've missed you.
Thank you. I missed being here. I was back Monday, but it's great to have both of us back here. And today we're going to be talking about exchange-traded funds, or ETFs. Why they're underappreciated, according to our ETF-loving guest today. We break down the different flavors, what to look out for, and how to read their ingredients like an FDA label. In fact, ETF is our word of the day. And this episode is brought to you by the number $9.05 billion. That's how much money is poured into commodity ETFs since those April 8th lows, and you can double that if you include precious metals. We're going to dig into how truly diversified your portfolio is, even as bonds continue to disappoint year after year. Is the 60-40 portfolio dead? And without further delay, let's get to our featured guest of the day, Todd Sohn. He is the senior ETF and technical strategist at Strategas Securities. And Todd lives and breathes ETFs. I know this for a fact. His enthusiasm for the asset class is palpable. Every week, he sends me a slide deck full of original analysis on ETFs, stuff I am truly seeing nowhere else. And we're going to share a bunch of that with you, the viewer, today. So Todd, I saw you last week at a CMT event that's chartered market technicians for chart nerds like me and, well, some others. And you gave a great presentation on kind of the state of the market here and how you're seeing that through the lens of ETFs. So just give us a brief rundown.
First of all, that was a very kind introduction. Thank you so much, guys.
You bet.
It's great to be with you again. Let's see. State of the market. We are back to new all-time highs in stocks. Bonds are still struggling here, but you do get 4.2% in short duration income-producing vehicles. That's great. And I wouldn't be terribly surprised, given the run we've just had, one of the best 3-month runs in history coming off of the April market low, to see stocks maybe chop around for the summer. I don't think that's unreasonable. Think of a car going 0 to 60, and you kind of got to cool the engine off here. So still in very good shape, but be patient, I think, over the next couple of months.
All right, so let's get to our word of the day, ETF, and we're going to break it down for the viewers. An exchange-traded fund bundles many stocks, bonds, or other assets like commodities, cryptos, into one ticker symbol that trades intraday like a single stock. And I say intraday because, unlike mutual funds, they trade all day long. You can only get in and out of mutual funds at the close of the day. So ETFs come in many different flavors. A recent trend is the use of leverage, and we talked about that the last time you were here, Todd. So just tell us about ETFs in general.
So ETFs do two things, I would say, for investors. One, they're a great low-cost, long-term investing tool, depending on what you're buying, right? The idea of saving for retirement or maybe that big purchase down the line, a house, a car, Xbox, who knows? But they're also a great lens into the temperature of the market, right? I can see what ETFs are outperforming, where flows are going, what kind of products are coming to the market, because ultimately if something's hot, you're going to see many issuers launch similar types of products, copycats to an extent. And that can give you a pretty good sentiment check. And I think that's very helpful if you're someone who is more in the weeds on a day-to-day, week-to-week type of basis.
So what's going on with these leveraged ETFs?
So let's see. The bulk of ETF assets are in passive investing vehicles. Very boring.
Like S&P 500, Dow, whatever.
Keeping it simple for the long run. That's what 98% of us should be doing for the long term, all three of us.
But the 2%
but
who
the
like
2%
leverage
like to use what are leveraged vehicles, and you're basically going to get 2 times the return on a daily basis for an asset. And there is a very new trend, it's only about 3 years old, where you're putting leverage on single stocks now. So if I'm very bullish on Nvidia, I can buy a 2x levered Nvidia ETF that if Nvidia is up 2% today, the fund should give me a 4% return. And you're seeing this explode to stocks all the way down the cap scale. So very volatile type of names like a Rocket Labs or Archer Aviation or Hims and Hers, really kind of esoteric stocks that maybe they're the future growth companies of America, but are also very much high conviction if you want to scratch that itch away from just pure passive investing.
How do you even find leveraged? Like, is it just when you're doing your buy order on whatever brokerage you use? Is it just like an option when you go to a certain ETF?
It has to be a approved product to be issued, right? So there's probably about 130 of them right now. So they're not available on everything. Issuers such as Defiance, I'm very friendly with Sylvia Jablonski. She's great. They come out with these ETFs. They get
friend of
approved.
the show.
Yeah, she's excellent. Wonderful person. and they'll say, all right, we're going to file for a leveraged Rocket Lab.
Oh, so they're different tickers.
Oh yeah.
So single
Yeah.
ticker, like you can bet, okay, do I want to buy Tesla? Because I think it's going to go up today, you can get a 2x of the normal stock return. But Todd, just refresh us because we talked about the dangers of leverage before.
Yes.
And if you get, and I've seen this in real time, if you get a stock that's going like this and then it kind of chops its way north, you can actually lose money even though the stock has gone up on these leverage products just
Right.
because of the volatility.
So you have to, this is where reading the label matters. They reset the leverage every single day. So today you are supposed to get 2x the return or inverse the return depending on the product. That resets, and then tomorrow you get 2x from that point. It's not a cumulative effect. So
Right.
there's
So
a decay involved.
Even if it's up after a week or net on the month, you might
Right.
not experience that in the daily.
You really want these products. I mean, technically you're not supposed to hold them for more than a day, but if there's a very fast uptrending market, that's when real profits are made. If you chop around, then you're going to end up with losing more than what the actual underlying stock has done.
So which sectors or stocks are big right now in leveraged ETFs?
Yeah, I know I was just going to ask about tech. Like large cap tech is huge, and then tell us about that and some of the dogs.
Tech, communications, and some of these more thematic industrial type of plays. I keep saying Rocket Lab or quantum computing is also getting big.
Sure.
Stocks that are really less trafficked in passive indices. They don't have a lot of heft, but they're very trader friendly. You'll find them on message boards and whatnot. People liking a product, maybe they're drone makers, right? Those are popular too. But you're not going to see them for something like Verizon. That's just too boring. Nobody wants that. Verizon's a dividend type of stock. So you won't get it in say, consumer staples, telecom, but you're going to find it in very high beta type of names that usually come from the technology sector.
One of the things you flagged that I thought was fascinating here is Nvidia. So Nvidia makes up about 7.5% of the S&P 500, and you compare Nvidia to entire sectors. So utilities is about 2.5%. So Nvidia is 3 times the size of all utilities put together, all the utilities in the S&P 500. Energy, it's 2x. Staples is 5%, 5.5%. So it's just kind of 1x that. But then healthcare, which is a huge sector, you think about Pfizer, Merck, and then all the, some of the smaller companies like Moderna. Healthcare is 9.25%, and Nvidia, the biggest stock in the solar system, is closing in on that.
This is a really fascinating aspect right now. The S&P is this ever-changing index. 30 years ago, financials were big. 20 years ago, energy was big. Now it's tech. And if you think, if you're an investor, you think, okay, I'm buying the S&P 500, I'm buying big U.S. stocks, I'm diversified. That diversification is shrinking by the day because tech is overwhelming the index, and Nvidia is bigger than staples, it's bigger than energy, it's bigger than utilities, real estate materials. It's closing in on the industrials and healthcare. So one stock is bigger than these massive, massive sectors. And so, okay, that's great. It's benefited investors. But if you're looking at a portfolio and you own the S&P and you own large cap growth by chance, and maybe you own a thematic AI fund because you're bullish on it, that's a lot of exposure to a small cohort of names that are usually found in those indices like Nvidia, Microsoft, Meta, right? So I just worry that investors need to understand what they own now. It's becoming more and more important just given how these companies are really taking over the world.
I want to ask you too, I noticed this a few months ago, did a chart segment on this. There is a disconnect between the XLK, for instance, and XLK is large cap tech. It's one of the spider funds. It tracks the S&P 500 tech universe. And the actual, if you were to compute all of the weights, market cap of all of the tech funds in the S&P 500, XLK is actually underweight on a lot of names. So, and that has to do with laws that go back to the 1930s and 40s. So highlight, some of the risk to investors. You think you're getting large cap tech, but you're actually underweight some of the things that you might think you're buying.
These rules were created for 40 Act funds, right?
1940. Yes.
We're getting into close to 100 years when this was made. And it appears to me that the market is now challenging these rules that were made. And they're challenging index providers to say, hey, these rules were not built. This methodology was not created for trillion-dollar type stocks.
The ETF vigilantes. That's what I'm going to call them.
That's I love that. That's excellent. I've never heard that before.
I just made it up.
On vigilantes.
But
you said leverage isn't for everyone.
Yes.
How do you decide whether you want to wade into that? Because it sounds risky, but it also sounds like
alluring.
But if you're just choosing something like Nvidia, how big of a risk is it?
So there's massive risks because let's just say Nvidia comes out with a report oh my gosh, we have a semiconductor problem or we miss earnings. And if the underlying stock goes down 10%, you'll be down 20.
Okay, but if it goes up 10%, you go up 10%.
But also, if it goes up 10%, then it comes down 10%, then it goes up 20%, you can lose money. So this is, you have to pay attention. It's more day traders.
The best thing you could say is, okay, know what your risk tolerance is. If you're 21 years and older and you walk into a casino, do you get uncomfortable or do you love the lights and the chips and the cards?
That's a good analogy.
But just know, okay, I have $100 to spend. After that, I'm leaving the room. So you really need to understand how much of an allocation you'd want to use for these leverage products.
That's fair. It feels like something I'd want to like play with maybe.
Yeah, I wouldn't bank on it for a house.
No.
How about options on a levered ETF?
Okay, I have always wanted to try that. I'm too scared.
You could do that. I mean, maybe that's because then if you use an option, you know what your risk is. You're paying.
If you're buying it, you have defined risk. You put up the money up front, and you just let it sit, and maybe you hit a home run.
Let's be real. This is a ETF passive girly over here.
Your risk is defined using options, which is the good part.
Fair.
Talk to me real quick. We got a minute before the break about healthcare, because this is one of the dogs that I was thinking about when I said that word.
Yeah. So, gosh, healthcare
not loved,
unloved. Massive outflows from healthcare sector ETFs, so it's very cold temperature. Investors don't like healthcare. Healthcare's performance over the last 5 years is in its bottom decile to the S&P using 50 years of data. So
and that's performance, not even flows.
Yeah, really bad. So big outflows, horrendous performance. Can this thing ever work again? I mean, I've wanted it to, and it's just been wrong. But healthcare is interesting because you get value characteristics from pharma and equipment and growth characteristics from biotech. So there's a lot of interesting stuff going on in that sector.
I agree. And there are biotech ETFs, which leave out the big boys. We need to take a short break, but coming up, we're going to be talking portfolio diversification with commodities ETFs and a culinary runway showdown that might just get you reading those ETF ingredients after all. This episode is brought to you by the number $9.05 billion, which is how much money investors have poured into commodity ETFs since those scary post-Liberation Day lows on April 8th. Now, I got this from one of your slides, Todd, and I note that precious metals are actually also in the $9 billion range there. So you add those two together and $18 billion, I keep wanting to say trillion, but that's actually challenging crypto for the number one spot in what has been working the best in terms of investor expectations since those April 8th lows. And so spot crypto has taken in 19.97, basically $20 billion. And commodities, including precious metals, is too. So talk to us about that.
I think investors are realizing that, okay, 10 stocks are almost 40% of the S&P. Defensive sectors, like we were talking about before, only 20%. That's a 35-year low. So this diversification benefit is disappearing. They need to find other routes to, whether it's protect or just alter a portfolio. Crypto is clearly becoming an important allocation. There's also probably a fear of missing out aspect to that. And then commodities can at least offer uncorrelated returns to stocks, ideally. So I think that's where the gold comes in, or you can buy a broadly diversified commodity ETF. So you'll have energy, agriculture, some other metals like palladium and platinum. Mm-hmm. This is all very much a diversification play rather than chasing returns like you'll see from some other groups.
Gold has been a thought for me because when we did see the markets kind of turn down in April, I believe, and they've recovered since then, a part of me was like, well, you know, I don't think I have enough diversification, even within my ETFs, by the way, which we can talk about. But I looked at commodities, people talking about silver prices, gold prices. So what do you think about commodities for a passive investor? Like, does everyone need X percent?
I think it helps. Now, there's some tax differences, right? They can be taxed differently, but I think that's
like
more of a
1040 contracts,
K1 type tax. But I wouldn't worry about that too much, depending on what type of investor you are. But they're at least different. They're not Nvidia, they're not AI, they're not technology. So gold, right? There's a movement towards gold because of the geopolitical that's going on. We can figure out any catalyst, right? Maybe it's a weaker dollar that benefits gold too. So I think having these assets that can rise during equity volatility is just a benefit to protect your portfolio. It may not make up the whole difference, but at least provide a padding. You fall down, you fall on a mat, you'll be okay, as opposed to on the hard floor.
I posed a question at the top of the show: is the 60-40 portfolio dead? And traditionally, this is the 60-40 portfolio is 60% equities, 40% bonds, and that's something that has worked on and off through large spans of time. And it really worked in the 80s, 90s, and the first maybe 15, 20 years. But after the pandemic, it has done very poorly. When we had the 2022 bear market, bonds lost money. And so they exacerbated the downside in investor portfolios. So what do you think of bonds right now?
I like staying down the curve. We don't want duration risk, which is how much your bonds will be affected by moves in interest rates. So I can buy a 3-month treasury bill, I can buy a 1-year treasury bill, and I will still get around 4%. That's pretty good. If I buy a 10-year treasury or a treasury ETF, I will get maybe closer to 4.5, but it comes with a lot of volatility because of the duration risk. We're about 10 months since the first rate cut from the Federal Reserve in this cycle, last September. Long duration treasuries and long duration corporate bonds are down since then as an index. So that's really rare. Usually bonds rise after rate cuts.
That was a slide in the deck you sent me. So this is a very rare situation. And let me throw in this, because the news of the day is President Trump was threatening to fire Jay Powell. And he's talked about this before, but apparently there was a letter that got circulated. The New York Times got a hold of it. We saw stocks dip to the lows of the day. It was a fairly dramatic sell-off in a short amount of time. And then Trump recanted. Stocks popped up again, but how do you see this risk affecting some of these shorter duration assets? And because this has to do with where the Fed is going with its short-term rates. So
if you start to see rate cuts, which we'll see if the administration has its way, I have no edge in that, right? It's a lot of noise, which is why we want to invest for the long run. Rate cuts will start to impact those short duration bonds. You will get less income. That's the risk if you have most of your money in short-term bond ETFs. Now, on the long end, okay, maybe if rates do decline, that could actually give you a little bit of a boost in terms of price return for a longer duration bonded ETF. But just remember the volatility involved. I think that's, can you stomach the ETF labeled treasury bond being higher volatility sometimes than stocks? That's really tricky. I don't think a lot of investors realize that.
Another potential diversifier, international stocks.
Good question.
A few people have said to me recently to own X% of international in your portfolio, and a couple of the answers were higher than I expected. So what do you think of international ETFs?
I'm a fan because they're less growth oriented than the US. Now, the US is the best market. I think there's no doubt about that. But we're at a point where, again, diversifying, I think, really matters. So I can buy Europe, I'll get more industrial and financial stocks. If I buy Japan, I get a lot of industrial stocks and really interesting consumer technology. Let's call it video games, right? They're great at making their games there. So Europe and Japan, I don't know if you want to be overweight to the US, but have some percentage of your portfolio. Maybe it's 5 to 10% in there as well. Emerging markets, I'm not sold on. I think that's easier to play using maybe an active manager who really knows the space as opposed to going passive. But you absolutely, I think, want to have international exposure at this point just for the diversification benefits and to water down how much growth and AI exposure you might have.
I wouldn't know how to pick one, though, I think, for international.
Dartboard works.
There's either dartboards or, listen, there's ETFs that are developed international ETFs from Vanguard, iShares, all sorts of providers that give you the whole world exposure.
Yeah.
It's the easiest route to go.
All right, we're going to stick with ETFs here, but we got to cue the runway lights, because it is time for Who Wore It Better, our markets-based take on a Hollywood gab show favorite. Now, on the left catwalk struts our ETF food label reader, clipboard in hand, squinting at a holdings list like a nutrition panel, highlighting every sneaky fee preservative. And on the right saunters the blind buffet buyer, a plate piled high with whatever looks shiny, no idea whether it's mega-cap carbs, junk bond fat, or a sprinkle of leverage spice. What management fee, you might ask? Now, Todd, I know you are a reader of the food label, aka the prospectus, but my question for you is, which contestant is wearing the current rally off of the April 8th lows better? The disciplined label reader who knows every calorie of risk, or the thrill seeker who grabs and gulps?
It's got to be the disciplined reader to me. I mean, the thrill seeker, just because we've had a really sharp rally, maybe they've
Crypto?
done okay. Yeah,
Anyone?
crypto, maybe they've actually done better in the short term, but I have to imagine the discipline wins out in the long run.
I'd like to think so.
I'll give the grab and go maybe a slight edge in the 3 months, but by the end of the year, those habits don't stay very well.
But how does an average investor, aka me or anybody I know, read a prospectus?
Yeah, how do you read the ingredients?
Is there a shortcut?
Well, there is now because of AI, right? I can go in ChatGPT or any of those and say, what does the prospectus for the XYZ ETF mean? Give me a summary of that.
But
we
do
didn't
you
have that.
believe it though? Would you believe it?
I always have a little, I don't know, reluctance. Now, the other route is if the ETF issuer is good at what they're doing, they will lay everything out for you on their website. So you go to the issuer's website, you find the ETF you're interested in, and they should have a bullet point summary of what this ETF is meant to do and where it might fit within your portfolio. So you don't have to go in and read the prospectus because those are very dense documents.
I used to write them, and I seriously, and I wouldn't say they're on purpose obfuscating, but it's just the length itself makes things daunting, and you got to repeat things at different places, and it's a lot of legalese, even though they're supposed to be written in plain English. Tell me about the fees, though. How do you look for a low-fee ETF and not get smacked with something you're not expecting?
So they'll have the fees on the website, right? This is required to have the fees, the bid-ask spreads in there. That's going to be on top of what you pay. But I think the more you look at ETFs, the more you realize Vanguard and iShares and State Street will have the lowest fee products for what that's worth. Those are the plain vanilla core type of passive holdings. Maybe Invesco too. But you could also just do a Google or an AI search. What are the lowest cost ETFs available for U.S. stocks, for international stocks? Like, do you have all these tools that weren't available 20 years ago?
100%. I get curious. Like, if you're just picking a big tech ETF, do you just like look at total assets and pick the one with the biggest one?
So it gets tricky. You could, but you also want to know what it's tracking because the indices have these little nuances.
Oh, tracking error. We didn't even touch that.
Oh, yeah. I mean, that's a whole other topic. But
yeah, we'll have you back.
I'd love to. I'd love to come back. What type of index is it tracking? Market cap weighted, fundamentally weighted? Is it actively managed by someone? So there's these nuances to the indices and how big certain stocks might be. So for most people, yes, market cap is the way to go, but maybe you need to change it up.
All right. And on that note, we got to kind of wind things down here. And it's been a fascinating conversation with you, Todd. We learned about exchange-traded funds, how they're different from mutual funds, and especially how to dig into some of these details that are easy to miss. And one of the standouts to me in this conversation is diversification, because I think in this market environment, it's especially important. And I like your idea of managed futures, not only because I used to be in the industry and that's how I got my start, but very important to think about these things. Time for a wrap here at Stocks in Translation, but make sure you check out other episodes of our video podcast on the Yahoo Finance site and mobile app. We're also on all your favorite podcast platforms, so be sure to like, leave a comment, and subscribe wherever you get your podcast. We will see you next time on Stocks in Translation.